Welcome everyone. I'm going to be doing a two-part video series, and the first part is going to be me interacting with Cathie Woods of ARK Investments and talking about philosophies that we match and how I can actually add some value to some of the things she's doing. In part two that I'll be releasing, I'll be actually using our platform to rebuild this strategy and showing how you can almost double the returns that she's gotten over the last 3 years by using the platform. But it also emphasizes some of the differences in how portfolios can be constructed and how they can be enhanced through an advanced technology. Let's go ahead and dig into this video.
Well, I founded ARK Invest in 2014 for two reasons. The first was to focus exclusively on disruptive innovation. I felt that it was a huge unmet need in the market because after the tech and telecom bust and then 08-09, so over those 10 years and even longer, we saw risk aversion rise in the market. And what did that mean? It meant to move towards indexed or passive strategies. And at the same time, we saw the search for innovation or getting exposure to innovation moving into the private markets. And yet there were some amazing companies in the public markets, and they were being neglected, both from a research point of view. They weren't big parts of indexes, if they were in the index at all, and from a valuation point of view. So there was a lot of low-hanging fruit. We saw companies in the private markets trading for 10 or 20 or 30 times the valuations in the public markets. So that was the first reason, and really addressing what I believe is the most massive misallocation of capital that has happened ever. This move towards indexation. More than half of the ownership in stocks today in the United States is in passive wrappers like ETFs and mutual funds. And so we wanted to actually become a hedge against the value traps that are populating those indices increasingly over time. So that was the first one. The second reason I started ARK was to evolve an open research architecture and patterning it after open source software. You know, there are a lot of contributors to open source software, and they are not paid directly for contributing, but they may be elevating their status in the community. They may be helping their consulting practices. They may be trying to solve a problem in their own businesses, and so open source software has helped them. In the same way, I feel that there's so much innovation taking place at the same time now. I mean, we've never seen anything like this, and we can go into that in a moment, that it's not possible for one research house to be able to research these ideas effectively. And in fact, I think research departments in our business, the asset management business, are going to have to restructure entirely in order to understand how innovation is going to evolve in the world. So right now, most of the traditional asset management world is very siloed, very specialized, very short-term in its focus. What we have now are innovation platforms that are cutting across economic sectors. That's not how the world is set up in traditional asset management. And yet that is how it will have to be set up if companies want to capitalize on the exponential growth curves and trajectories that our 5 platforms and 14 different technologies are offering today.
So a number of things I want to talk about that Cathie brought up in this first part of her conversation is actually that there was actually not a move to indexing in 08 and 09. That didn't happen until around 11 or 12. In 08 and 09, people moved toward the active management because they realized that the passive is how they got stuck into investments in the first place. Now, I built the platform back in 1998, which was the virtual portfolio manager, and now it is the portfolio expert platform. I'm going to show you how our innovation actually moved everything much closer and than she thought and what she was talking about. Now, my entire platform runs on open source. We run Linux servers. We run Eclipse on IBM. Everything is open source that we do. So we are participating in this open source environment and have since we started the business back in 1998. So let's go ahead and listen to her for just a couple more minutes, and because there's some things that she's going to talk about that I want to interact with, and then I'm going to show you how to make Cathie Woods even better than she ever dreamed.
Yes. So I funded the firm for 3 years by myself, and I obviously thought that we were going to take off a lot sooner than we actually did. And part of the problem that evolved was our first wrapper was the ETF. And my question to the marketplace and to anyone who would listen to me is, wait a minute, this is a really good wrapper for the end investor. It is cheaper, more cost effective. It's more tax efficient. It's more liquid, and probably most of all, and most important of all, according to how our clients have received us, is more transparent than the traditional world. And I was saying, okay, that's great. Why can't active do this? Why is this, only a passive wrapper? And so just doing that, I thought that my sort of network in the traditional financial world would help me with this idea. But what I learned very quickly is, wait a minute, you're in a different world. The passive world and the active world, that infrastructure, those people don't talk to each other, and they also don't trust each other. And so, at one point, probably 2 years in, I was saying, oh my goodness, wow. And so we had to pivot and do separately managed accounts and so forth. And that's what really got us going, getting an institutional account. I think we were somewhere in the $20 to $30 million in assets under management, and we had been stuck there for a long time when one of my former clients, an institutional fund, a state pension fund, gave us $200 million. So that really put us on the map. I don't think we would have survived if that had not happened. And it happened, there was a lot of serendipity involved, if I can say so. So yes, we were in a foreign land. I didn't realize that before I entered it, but it was foreign, and there was more hostility than I had expected. I thought we would be welcome because this would be the next big wave for ETFs, for the ETF industry's growth.
Yeah, so this is an interesting conversation to jump in on. I wish I was having this conversation directly with Cathie, because I would, and I hope that maybe this video inspires that conversation at some point. One of the things we have to recognize that mutual funds and ETFs are old legacy technologies. Now, ETFs are similar to mutual funds. They're structured the same way. They have allocations to different individual stocks. The difference is how they're traded and how they're packaged. And one has one NAV at the end of the day. The other one you can buy and sell as it's being repriced in a real-time mode. Most of this stuff, and including Cathie's type of ETFs, they're not being priced real actively, not like an SPY or an index type situation. Most of it is still being transacted at the end of the day. But my argument is this, is what we're doing with our technology, and we're disrupting the disruptors. So I'm going to show you here in a few minutes how I've taken what ARK has done and dissected that to a next level, took their fees out of the way, eliminated all fees, make it totally open. The only thing that we have is a platform fee to do this, but I'm going to show you how to take this and repackage the ETF world. Now we have a couple things that have happened, and literally in the last 12 months these things have happened, is Charles Schwab took off the ticket fees, and we also have, thanks to Robinhood, and we have fractional shares. So the environment as we go forward is going to be much more dynamic, and the way it's going to be dynamic is that if you have the right technology, you're going to be able to trade these individual symbols and manage them much more efficiently than even the ARK can. They're somewhat stuck in their allocation. You have a prospectus, you have to adhere to these things. Yeah, you can move things around and all that, but you can't go to cash. You can't really protect that asset. So let's say their favorite idea, Tesla, just blows up one day. Well, they're going to ride down Tesla. Those ETFs, you can already see that collapse earlier in 2020, and that happened very fast. It was quick. It came back. These funds have done really well because all the stocks, the innovative, and the 5 areas that she covers are areas that have come back and are part of the new economy, the new world, or the big reset that everybody's talking about. So the environment that we have to go forward in is going to be a much different from an investment vehicle standpoint. Now, we talk a lot about dynamic direct indexing, and this gets us into the point where we can build our own ETFs, our own mutual funds, and taking any symbols, mixing them, and running some very sophisticated logic, running a lot of iterations on when and how to allocate the assets as you go across time. And so I'll show you all of these things, but what she's talking about is very, very good. I really respect her, the story she just told about getting the big allocation. This is really typical with a lot of advisors that have around 30 million and they get up to 250, and that's a breakthrough, but it's not really that big of a deal. But the thought process, the innovative thoughts, and playing into that space is significant. And I think this is going to play out really well. And I think there's some really good things that are going to come out of those ETFs. But just know that at some stage, those ETFs are going to be stuck in the allocations. And no matter how strategic they try to be, they won't be able to really protect that volatility in these ETFs. And the problem I have with ETFs is just that they're packaged products and they're too static. Even though she's talking about being more flexible and transparent and things of that sort, in the end, they're not. They're still operating under prospectus. They're still locked into that philosophy and therefore holding certain types of percentages of investments and things of that sort. So they're flexible, yes, not really going to go to 100% cash. What I'm proposing is direct dynamic indexing is actually gives you the ability which to move to cash. If all of these investments came to an end, we could absolutely move them to cash and there'd be no problem with doing that. There's no prospectus, there's no SEC or anybody that's going to criticize what we do. And all we're doing is moving these stocks in and out. Now, one of the things that she discussed earlier is tax efficient and things like that. Tax efficiency in markets do have an effect, but they're not a major effect. One of my mentors used to always say, if you stay in the market long enough, they'll become tax efficient because they'll take care of the gains for you. The markets that we live in today with these unbelievable volatility and these skyrocketing prices, is that going to always continue? Of course it's not. So you need to have a protective strategy, a way to move these investments to cash at some stage. And what I'm going to show you here in just a few minutes, there's one more segment I want to bring in Cathie to discuss that it actually plays into everything that I think you need to know in being able to deal with these innovative instruments and these companies that are truly disrupting. And what I'm doing here is I've been a disruptor for a long time. We've been in the active space for a very long time. And as I said earlier, Cathie was talking about everybody moved the indexing after 08, 09. No, they didn't. They went the opposite. I know I was a beneficiary of the folks moving from passive to active. That period ended. Around 2011, 2012 is when we started to see a lot of advisory firms start to move back to passive. One of the things that I talked a lot about is that folks got into it's sort of like living in a gated community and having an alarm system. It's kind of redundant. The markets just kept going up. The passive investing worked. And I think the number is much higher than 50% of the assets. From an advisory world, it's probably 80 or 90% of all advisors are in a passive mode. And she's right about that. You know, trying to talk to somebody that's a passive investor and talking to them about active investing, you're going to go nowhere. I've dealt with over 1,500 advisory firms over the last 20 years, and I've seen all of the talk. And it's just, that is exactly how it has been, and it probably always will be. At some stage, the markets will take back the control of everything, and will, meaning that the volatility will be two-sided. We have very brief periods of volatility because of the Fed's action, but I do want to bring her back in for one more conversation piece. Then I'm going to go into the video on how we made her way better. Ultimately, when these companies roll over, well, that is where the value will really come in, when you start to dynamically adjust what you own internally in your fund.
But we were kind of, I won't say twisting in the wind. I will say I didn't understand why there wasn't more acceptance of what we had to offer, which was so differentiated. And as it turns out, after that drought, and after we got our first few separately managed accounts, in 2017, the combination of bringing in distribution, so we struck agreements with two companies. Absolutely. Think about what I said. More than half of all equities in the United States are in passive portfolios. And that does not even include benchmark sensitive. So what happened with active management is, after the tech and telecom bust in 0809, you had a stream of quantitative analysts move into our business. And what does that mean? What quant means is they're worshiping at the holy index, which I would call an idol. And basically the indexes are backwards looking. The companies at the top in these various indices are there because of what has happened in the last 40 years. If there's if disruptive innovation is going to be as pervasive as we think it's going to be, most of those companies are going to be sidelined at best. There's going to be huge consolidation. There are going to be bankruptcies, restructurings, and so forth. And so the irony here is the traditional benchmarks may not deliver interesting returns because of that. It's been a setup for that, unless they move much more quickly towards putting innovative companies in there. There's one company from an index point of view, and again, consider the source, but MSCI has put together a number of innovation indexes because they realized this was a problem in the marketplace. And they, I think, the strategists over there were thinking for a long time, how do we do this? Because they were watching ETFs being, birthed. It's sort of spaghetti thrown against the wall just to see which ones would hit. And they knew there was going to be, and there should be, a more thoughtful way of thinking about innovation in the public equity markets. They were watching our research. They, like many others, because we give our research away for free, they were watching our research, and they came to us and said, if we would like to collaborate with you, and all we need as an index provider are the keywords that you think are important in guiding us towards where the world is going. And so they use artificial intelligence, and they go scour the world for these keywords. So they're going to have very broad-based portfolios, very, very, maybe 400, 500 stocks per portfolio, whereas we have 40-ish stocks. So we're very concentrated. We're rifle shot. They'll be scattershot. But in terms of solving one of the reasons I started the firm, and that is helping the markets move away from this massive misallocation of capital towards something much better, I think MSCI has the right idea. And the way they're thinking about this is, in the 1980s, emerging markets were considered exotic, much in the way that innovation is today, believe it or not. And so companies, asset managers used to, tiptoe into Brazil or Malaysia or Vietnam and it's at a time. But each of those countries has idiosyncratic risks. Putting them all together in something called an allocation towards emerging markets helped solve that problem. We've had a much more efficient allocation of capital towards emerging markets because that became a category, both active and passive, right? We think the same thing is going to happen to innovation.
So one of the beauties of what I'm about to show you is how to take the ideas, innovation. There's so much I could do with someone like Cathie Wood. I've been looking for a firm like hers for a very long time. Having that innovation and having the view of the world forward-looking, not backwards-looking like we've been. I've been a disruptor, but no one knows I exist to a large level because we've been dealing with a small group of investment advisors, a few hundred firms, and the folks that we talk to are the ones that were willing to talk to us, which are the ones that wanted to look at an active process. And many of them, they come and go. They can't hang in there. They can't stay with what it takes to be an active manager and go through the ebbs and flows of this. We've brought in a lot of amateur firms into our environment that are just incapable of handling the type of environment that we were creating. And as we, this goes all the way back from maybe 2010 through 2014, that, everybody was really excited about this. But then 2015 was probably the single hardest year for everybody. Even the likes of guys like Ray Dalio couldn't make any money in 2015. And then there was a shift. And that shift may be a lot of what Cathie's talking about here, is where the old world started to become the old world. And even Apple is part of that old world. They're at the top of the index, as she was just discussing, where these are things that have grown over the last 40 years. And now we're starting to see the disruption. We're starting to see the world move forward. And after the whole COVID situation, this is actually resetting everything and probably going to move us a nudge over further that direction into the new world. And a lot of these old world companies will start to cease to exist, actually. They're already zombies because of the Federal Reserve and the stimulus, and there's companies out there right now that shouldn't even be in existence, in my opinion. They should just disappear and go away. But as these disruptive technologies come into play and other new ways of doing things start to move forward, they will disappear. That's going to be basically a natural rotation that's going to happen. But the key thing that I want to do in this first section of this video is actually talk about the goal of being very dynamic. And, well, Cathie's doing some amazing work. They're not dynamic. What our software was able to do, taking the ideas and how I unpacked everything that they're doing and put it into a different wrapper. When she talks about quants, I am not an index quant like she's talking about. I'm a quant from the standpoint that we're looking at every symbol in any portfolio we build are looked at on an individual level. And this is exactly how I see the world. And it also gives dynamics that you can't get in any other way. So let's go ahead and take a look and see exactly what we did with Cathie Wood's work.